Hello and good morning, everyone. Welcome to this September 28th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes as we kind of look at what's taken place in the market and what we can expect maybe from later today. Currently, we've got futures that are slightly red. Dow futures down all the futures are down roughly around 0.1% to maybe 0.3%, with the NASDAQ down the most, down about 0.3%. Crude oil prices, which absolutely surged yesterday, they are cooling off a little bit today, down right now just below $93 a barrel. We had closed up closer to $94 a barrel yesterday, a big move to the upside, not only in crude oil prices, but also in energy stocks, as they made a 52-week high. And the big story continues to be, excuse me, the 10-year Treasury yield, which currently is up 4 basis points today, on top of a big gain yesterday, big reversal yesterday, with that 10-year Treasury yield currently at 4.66%. Overall, yesterday was kind of a strange day. I thought in the afternoon we were ready to make a excuse me, big move to the upside. We had especially the Russell 2000, the IWM, was seemed to be turning a corner, broke its intraday downtrend line, held its prior lows, and started to move back up, and even threatened the highs that we've seen the last couple of days. And that's fairly significant because we've struggled to show any kind of higher high on the day on that daily chart on the IWM and across most of the indices. So still looking for that, but with futures down slightly this morning, we'll see whether or not the bulls have enough intraday momentum to carry stocks back up to the upside and hopefully take out some levels that look like they could be at least short-term resistance. Let's go ahead and check in with the action from yesterday and get this thing going. Got a lot to go over with you today. See if we can get through all of it. The Dow Jones Industrial Average yesterday down 0.2%. You can see the S&P 500 actually up a point, so relatively flat. But the way the day started and where we got to intraday, flat wasn't such a bad thing. The Nasdaq 100 up 34 points. That was up about 0.25%. Mid caps up about 0.6%, and small caps up almost a full percentage point. That's a little more than 0.9 percentage point. And transports up fractionally, up about 8 points, which was less than 0.1%. Looking at these AD lines, honestly, if there's one thing, I try to keep it real. Look at my signals. This AD line has been something I've talked about very bullishly in the past, throughout the bear market. Yeah, the AD line would go down a little bit when prices would go down, but we'd have a rally and then we'd get a big bump back to the upside in the AD line. Right now, if you look across the board, it's kind of hard to sugarcoat this. The AD lines are going down, which tells me that we're not getting very good finishes, obviously, to the day. And I always like to see bullish action at the end of the day. Hold on one second. So without those strong finishes, it's really going to be difficult to paint an overly bullish short-term picture. I'm still bullish long-term. I haven't seen any of my signals, really, any of my significant below the surface signals really start to turn bearish, other than what I'm showing you right now, the AD lines. The relative strength, all the relative strength seems to be good. The relative strength in small caps actually has been picking up because the market's been going down. It's not easy to notice, but I'll show you a chart that shows you, at least in the short term, money is clearly rotating back towards those small cap stocks. And that can be bullish for small caps. And I'm expecting small caps to outperform in the fourth quarter. So it's at least a start. I wouldn't back up the truck right now with too much of anything. We need to see a little bit more than what we've seen here in the past few days, but at least understand that there is some rotation taking place and moving more toward the small cap area. Energy yesterday and this was probably why the IWM, or this is one of the reasons why the IWM did better and has done better over the past few days. Energy was up 2.5% yesterday. There are a lot of small cap energy names in the IWM. The XLE is probably weighted about 3 times as much on the IWM as it is, say, the S&P 500. So anytime energy has a big move like this, you should be expecting at least some aid to the IWM, if not just providing some excellent leadership. Industrials up about 0.75%. So we see energy, industrials, utilities not doing so well. So it continues that the defensive groups really have been the worst performers. And on a relative basis, they should be performing well if you're anticipating a further market decline. And that's one thing that, I mean, say what you will, maybe confusion, but at the same time, these signals normally point to weakness being contained and short-lived. We'll see. We're through that really bearish or historically bearish mid-July through late September period that ended a couple of days ago. And so yesterday, it wasn't much, but the S&P 500 was up 1 point. Maybe it's the change in the season for the stock market. I don't know. But we had a lot more to prove, and we'll be following this as we move throughout not only today's session, but the next few days, weeks, as we head now toward earnings season. Utilities, like I said, that was a big drop. It is breaking down to a 6-month low. It is nearing a 1-year low, which was down around 59. So we're almost there, literally closing at 60.13 yesterday. And we've got energy leading. You see one of the energy groups here. This is I pretty much know all of the industry groups by symbol, but the energy, for whatever reason, I think it's because the ticker symbol doesn't really line up. Like the OL is the integrated oil and gas, but then the OI is oil equipment and services. And OI, you would think, okay, oil and integrated OI, but it's not, it's OL. They always throw me off. But anyway, so we've got integrated oil and gas jumping 2.8% and breaking out again. So clearly we've got leadership in the energy space. Steel continuing to try to make a little bit of a move to the upside. See that PPO starting to turn back to the upside, which is nice. AD lines really, even on the integrated oil and gas, as you see this moving up, the AD line, not really that strong. So it's not a convincing move at this point, but there are signals out there that suggest we could have a move back to the upside. Last one, heavy construction. This was a group that was doing extremely well throughout most of the summer. And then we moved into August and things just kind of started to fall apart. We lost at 1 point close to 15% to the downside, probably about 13%. And we did start to recover a little bit. Yesterday's move of 2.26% certainly helps. But again, when you look at every one of these charts that I've laid out here, every one of them show the AD line weakening, or even in areas like the integrated oil and gas, there is no real confirmation from the AD line. So that is the one thing that's got me nervous, or keeps me up at night, if you will. But overall, I'm still, again, seeing a lot of signals that would support a rebound. So I'm kind of waiting for it, waiting for capitulation. Yesterday was kind of capitulatory, but then the end of the day kind of came back down, which kind of muddied that picture just a little bit. But anyway, let's keep rolling here. 10-year treasury yield, getting an update, but we are up again today. Off the earlier high, we were up to 4.69%. Remember, 4.33 back here, 4.35. This was the area of yield resistance. And we broke above that a little over a week ago, and we have just continued moving to the upside, really ever since the Fed meeting. The day after the Fed meeting, we gapped up, and we've just continued moving up. And so a lot of that is the Fed speak. I mean, Fed Chief Powell came out and said, we're now expecting higher rates for longer. Didn't mean that he was expecting to raise rates any further. He just, at this point, that's kind of all on pause. But instead of 4 rate cuts next year, he said they're expecting 2. So they're still talking about potentially lowering rates next year, just not as much, which means rates stay up a little bit longer. You know, if we hadn't gone through the pandemic and you look at even now, and I said it before, I think we can go up to 5% on the yield. I think if we get over 5%, we sustain it up there. I don't know that it's the economy that can't handle it, because the economy still seems to be pretty strong, or at least okay. I won't say pretty strong, but some areas of the economy better than others. The thing that worries me about the market, or about treasury yields rising and getting above 5%, it's not about the economy. It's about investors and their psychology. I mean, once you get to a 5% treasury yield, you could see folks beginning to move from the stock market back into the bond market. And right now it's kind of, as rates go up, if it's based on economic strength that the Fed's forecasting, I think that's ultimately a good thing for stocks. If it's because the bond market's starting to feel more pressure from inflation, that's not a good thing. Because what you don't want is a slowing economy and rates going up because of inflation. That could be much more of a problem for the stock market down the road. I don't think that's where we're headed, but you at least need to consider alternatives to the way you're thinking. And so I just continue to watch. And what I really watch and monitor are areas of the stock market that you would think would be going higher if there was an inflation problem. Real estate would be one. Real estate's been absolutely horrible. Gold, if inflation's going up, you should see the volatility spiking, which we have. And you should also see gold spiking relative to the S&P 500. And because the S&P 500 has dropped, actually, let's go ahead and pull that chart up, because I haven't looked at this one in a while. But let's see what the S&P 500 is doing relative to gold, or actually gold versus the S&P. Yeah, I mean, we've had a little bit of a pop, but look at where we were back in May and where we are now. And by the way, gold yesterday, look at this move. Breaking down below this 1900 to 1910, 1915 area of support, losing 1900 for the first time since all the way back in probably the second week of March. So again, if inflation's the problem, what's going on with gold? What's going on with real estate? I mean, XLRE. Does that look like an area that's about, poised to explode because of inflation? Money's not rotating into there. If anything, money's rotating out of the XLRE. Let me adjust this chart so you can see what's going on. But here's the XLRE relative to the S&P 500. Does it look to you like money is rotating into it? Seems pretty clear to me it's rotating out of it. So, and when we look at inflation, and I've probably shown this a few times, but if you haven't seen it, let me see if I can put this together real quick. So you do dollar CCPI. That's how you type in the symbol for the core rate of consumer price index. So it's the core rate of CPI. And let's go down to here. We'll put in a rate of change. And I think that should do it. We'll leave that, and we don't really need the moving averages. Definitely don't need the PPO. All right, I think that should be the chart we need right here. Oh, no, we don't. We need more than 1 year. Let's go back 50 years. And by the way, folks ask me, how do you do more than 20 years? Because they can only get 20 years on their chart. If you can only get 20 years on your chart, it's probably based on the level of service you have with stock charts. Because I believe, basic, I don't think is going to go back more than 20 years. I don't know about extra. I have the pro level. So if you have extra and you're not getting more than 20 years, then you probably need to upgrade to the pro level. But here is the consumer price index, the core consumer price index, going back 50 years. This is just the actual reading of the CPI, core CPI. Down here is the 12-month rate of change. I mean, I don't know, maybe inflation's a problem, but what I'm seeing is a pretty steady and consistent drop in the core rate of inflation from 6.7% a year ago to 4.39, 4.4% now. So we've made it halfway back in a year, halfway back to the Fed's 2% target. Now, I don't know if the Fed is just trying to talk tough to kind of keep the market in check, the stock market, because anybody, if you get the market rolling, goes back to new all-time highs, that can be a little bit inflationary because people feel like they're richer. They feel like they have more money to spend. And so I get what the Fed's doing or trying to do, but they're just not very transparent in doing it. They keep changing their tone. And that's leaving the market, I think, maybe with a sense of distrust of the Fed. Anyway, let's keep moving here. S&P 500. So what I was explaining, what I've been explaining to members, we talked about this a little bit in the trading room yesterday. I really want to see a capitulatory type move to the downside. Something that gives me not only the feeling that we put in a bottom, but a measurable target where I can put a stop if I'm wrong. And so here we've got a tail that came down. We came back up, and on an intraday basis, if you look at a 5-day, I mean, look at where we were. We were at the high of the day after 3 o'clock. So if we had continued moving and we could have finished back up over 4,300, to me, this would have been a no-brainer. Now we started to roll over, but then right in the last 10 minutes, we had another volume surge, which is typical right at the end of the day. And we turned higher on that. So, and if you look back the last couple of days here, we turned higher into the close, big volume. Here we turn higher into the close with big volume. Here we flatten out. This was the only day that really we saw selling all the way into the close. So those are just subtle, maybe subtle signals. I don't know that I rely on that very much, but I do like the fact that we've got this long tail, and I would have felt better if we'd have finished on the high, because then that would have been a nice hammer. You can see the volume actually did tick up, which is good. I wanted to see that. And then when you look, well, I'll save that. I got some other charts I'll show you. I was going to show you 60-minute positive divergences. We've still got that across the board, but we'll look at that in a little bit. NASDAQ 100, same thing, long tail down below 14.5, came back up, but it wasn't quite as bullish a candle as it could have been if the market had closed about 45 minutes earlier. But hey, it all counts. Next up, IWM. I mean, I do take a little bit of, you got to start somewhere, but we do have 2 hollow candles out of the last 3. And if you look back during the entire month of September, since the initial day of September, we only had 1 hollow candle that's where you actually close above the open. We only had 1 hollow candle the entire month up until Monday. We had a pretty good one on Monday, light volume, not really easy to get too excited about that one. Went back down yesterday on increasing volume, but then we tried to reverse on this big volume today. Now, if we go back down on these major indices and we go back down below those prior lows, all bets are off again. It was good to see on the IWM, this gap support right here. One of the things that I've been talking about is gap support to me was the first, once we broke below 4,300 on the S&P 500, gap support became the next key support area. And it was really back at the beginning of June. And there's the top of gap support. Here's the bottom of gap support. That bottom of gap support was 174.35. The low was 174.36 on Tuesday, 1 penny above. Remember when it was coming down, I said our highs were 1 penny off. All right, sorry, this thing's not working very well. There's the high, 177.03. And then this high, 177.02. 1 penny from showing a higher high. Well, this was 1 penny from a major gap support area on the IWM. Also, if we go back to that S&P 500, here's that gap support on the S&P 500. Want to know what these numbers were? 41.21, or excuse me, 42.21, was the low end gap support. The upper end of gap support is 42.41. That was the open. Yesterday's low was 42.39. So we went down into this gap support zone before reversing. Could this be the capitulatory move off of the gap support? Maybe that launches us? Possibly. But that low yesterday now becomes somewhat significant, 42.38. We go back down below it again. We're right back where we were in the downtrend, hitting new lows. And in that scenario, you got to be careful. What else? All right, let's talk a little bit about the chart of the day. Got a few more minutes to go here. I got some more charts to show. Listen, if you haven't already signed up for the chart of the day or for our EB digest at earningsbeats.com, please go over to our website, earningsbeats.com, scroll down, and there it is. Sign up form, name and email address, hit the subscribe button. No credit card required. You're not going to be charged anything. Honestly, I do it because I want to do it. To help folks learn a little bit about technical analysis, learn about the way we approach the market, which I think is a little bit unique. My background, I was a former practicing CPA. I was in public accounting for 20 years. I have definitely the fundamental side of this, but I do follow the technicals for entry and exit. But fundamentals shouldn't be lost. And that's, a lot of times, everything is baked in terms of price, but you still have to have some kind of a mix and kind of be able to put all areas of the puzzle together in trying to come up with what the overall market looks like it's most likely to do. Nobody knows what it's guaranteed to do. Nobody. I certainly make plenty of mistakes in my calls, but I think I have a pretty good track record over time. And a lot of it is from that CPA background, just some of the things, I'm a little OCD, as you probably know, on a number of areas, but especially the seasonality, the historical actions in the market, which I think are really important. I think you always have to have a healthy dose of perspective when you're looking at the market. Try not to get overly swayed by media on either side, bullish or bearish. Anyway, I try to pass along a lot of that stuff. Make sure you sign up. It's a 3 times a week newsletter, Monday, Wednesday, Friday, 2 paragraphs in a chart. It's going to take you probably 2-3 minutes and you'll be done. Have something maybe in the back of your mind, maybe to think about. Maybe it'll add something to your own trading arsenal, whatever. And if you don't like it, unsubscribe. You won't hurt my feelings. I'm doing this for free for whoever wants it. Anyway, check that out. And make sure you sign up today. When we do free events, we always reach out to our EB Digest community. All right. So chart of the day for today, it's got to be crude oil. I mean, yesterday, look at the big move here. We went up 3.6%, closed up at 93.68. We moved up to 94.17 intraday. And if you stretch this out, let's go back 3 years. 94.17. Which was the high there. If I go all the way back over here, that's 93.74 high. If I go here, 93.64 high. And it really isn't until you go all the way back over here where you hit these highs in August of 2022, up near 97.98 in this range. 97.37, 97.66. So, we could pull back at any point. We got the rising 20-day that's been offering some pretty good support here, but we could be heading for 97. I wouldn't be surprised to see this result at some point in the fairly near term, where we move back up into that 97 range. All right, let's see what else we got. How about what was I going to do? Oh, this is the hourly chart. So here are the positive divergences I want you to be aware of. Prices going lower. It all started about 2-3, probably started 2 days ago. Slight positive divergence on this low. Then we rebound and we go back down to more lows. And when we get down to both of lows the last 2 days, we're still holding above that prior where that PPO was. And we're starting to turn up again. First thing we need to do is get through the 20-hour EMA. If we do that, normally what you get is what I call a PPO reset. And that's where you get a move back up to the 50 period moving average, in this case, 50 hour, and the PPO resets back up to the center line or close to it. That's what I would be expecting off of this. So this is a short-term technical signal that lines up and suggests that maybe yesterday was the start of something. Now, I'd like to see these hourly charts continue to print higher highs and higher lows. We got it started at the end of the day yesterday with 2. Go down intraday, even below about 42.60 or 42, what is this number? 42.64. So if the S&P is down 10, which would be about 0.25%, we could break that short-term series. Now, it wouldn't be the end of the world, but I would like to see this during the day without breaking down below yesterday's lows, get through this 20-hour EMA. All right, what else do we have? Let's look at the NDX. Same chart, lower lows. Look at, I mean, I think this PPO looks even better. Look at that PPO turning up. Nice finish yesterday. We went through the 20, couldn't sustain it though. Closed just beneath it. Let's watch this one. How about the IWM? IWM, I mean, that PPO looks even better on that latest low. And we are kind of threatening. The only bad news here, we don't have as much room to get to the 50-day. And then you've also got gap resistance, recent highs up near 178. So this is going to be the first real test. We already got through the 20-hour EMA. The real test is going to be to negotiate 178. I've talked about 177.03, 177.02. That would be the initial sign that, hey, maybe we're turning around. I think the bigger one would be getting through this gap resistance zone. And it starts with trading up in the 178s. So watch that on the IWM. Another chart I wanted to show you. Still got a couple minutes here. The IWM versus the QQQ. I talked about it at the open, how we're starting to see money rotate back towards the IWM relative to the QQQ. This is going back the last 4 months. And you can see we go through periods, some periods where we absolutely explode on small caps. That was the beginning of June. Then we go back through a period where we go right back down. Then you can see for about 6 weeks, we were rising. And then for the last 4 weeks, I guess, we've been declining in a pretty, you probably draw channel lines in here, pretty distinct channel that we've been in. And it looks like that's been broken. We went through about 10 days right in here, sideways action where nothing was really leading. And then we broke out to the upside. So it's starting to show again, this isn't, I mean, literally it was yesterday's action, last 2 days action, I would say, that has triggered this. That's not really a big sample size. I'd like to see some continuation, but it is a signal that things are starting to turn. So I'm just pointing this out because these are things, and this is something I really haven't paid a whole lot of attention to until we started going through the pandemic, after the pandemic. So this isn't a long-term signal I've used by any stretch. And the one I'm going to show you right now is a signal, honestly, I hardly ever use. And that is, I was looking at the AD line intraday, and I don't like AD lines intraday. I don't like any signal intraday where it's open, low, close, or high, and you're looking at the close is important, because on an intraday basis, almost every close, all of them until 4 p.m. are not really a close. And so if you're looking at the PPO, like on a daily chart, you can't really pay attention to what it's doing today, intraday. You need to wait for the close because the PPO is based on the closing price. Anyway, the AD line is based on where, you start the period and where you end the period. Are you at the upper half of the candle or are you at the bottom half of the candle? Upper half, AD line goes up. Bottom half, AD line goes down, right? And it's also volume driven. So volume is the multiplier. So I was looking at this and the daily IWM AD line's going down. But if you look at this, the AD line on a 10-minute chart was going down too, until we got to the end of the day after the Fed meeting. So this would have been at the close last Thursday. Since then, as we keep going down, this intraday AD line keeps going up 4 days in a row now. So this one, we went right down to the bottom, but last 3 days, it's been pretty steady, even though we've gone down, set new lows. And look at what happened yesterday morning. See all the volume that came in the morning? It was coming in with a few really solid hollow candles. So all that volume was on the buy side. And that's why the AD line was moving up. And then when we went into the middle part of the day where we saw a little bit less volume, that's when most of the selling occurred. And then we picked back up again with volume. So I'm looking at this and I'm saying, well, maybe the daily AD line isn't really showing the whole picture because it's only looking at where we're closing. And we've had a couple of hollow candles now the last 3 days, but we also had the one here where we finished all the way on the low. So the entire volume, even though the intraday AD line was relatively flat, a little bit down, but all the volume on the AD line for the daily chart went down. Anyway, I don't know what that's worth. Just wanted to point it out. It is 9:30 now. Market's been open for roughly a minute. So first, let's see what the market is doing. The Dow's down 6, S&P's down 5, NASDAQ down 47, so a little bit more on a relative basis. Small caps both higher. I'm also watching the VIX. I don't know if you saw the VIX. Many times, bottoms in the market are formed when the VIX starts printing these long tails to the upside, showing that they can't sustain that high volatility intraday. The top here, you can see a long tail to the top. Here, long tail to the top. Here, long tail to the top. Here, not so much long tail to the top, but we did fail at a major resistance level, which was at 20. And by the way, yesterday's high was 19. This is today. Yesterday, I think it was 1975 or thereabouts. But look at all these tops. Look at all these long tails, reversing candles. Here, bearish engulfing candle. I mean, this is the way bottoms tend to form. So I'm looking at these tails, and maybe we get one more. Maybe the market sells off. We go to new lows. Maybe that VIX spikes up above 20. If it closes above 20, you want to be really careful. But if it goes above 20 intraday and comes back down below 19, that would be another signal to watch. Anyhow, everybody have a great day. I'll be back next Tuesday for your next Trading Places Live. Of course, all of our members, I'll keep you posted. I'll tell you what I'm seeing throughout the day when I do the daily. Actually, I am meeting today with a couple of our team members at Earnings Beats. So John may be putting out today's DMR just to let you know. If there's anything I feel like you absolutely need to be aware of, I'll either pass it along through John, make sure he gets it in that update, or maybe I'll shoot a quick note out if I have some time. But I will, even though I'm in a meeting, trust me, I will have one eye on the market all day. Anyway, everybody have a great day. Happy trading. Enjoy the rest of your week and weekend. And maybe, just maybe, we'll be shifting into a more bullish period for the market. Have a great day, everybody. Happy trading.